Republic Services beat Q2 2026 consensus. Revenue came in at $4.43 billion, which is up 4.6% year over year. Adjusted EPS was $1.85, a 4.5% increase.
Management immediately followed that up by raising full-year 2026 guidance.
Right.
Revenue is now projected to land between $17.2 billion and $17.3 billion.
Right.
Adjusted EBITDA is forecasted at $5.525 billion to $5.55 billion. And the new adjusted EPS target is set at $7.23 to $7.28.
The stock saw an initial moment of algorithmic hesitation right after the print, but high-volume buying stepped in pretty quickly.
Yeah, pushed the shares up 1.24% in the regular session.
Exactly, to close at $209.59. It did slip just slightly to $209.20 in after-hours trading, but, here is a paradox we are unpacking for you today in this deep dive.
The core contradiction in the report.
Right, Republic Services is making significantly more money while picking up considerably less trash.
It is wild. The physical mechanics of this business are diverging entirely from the financial output.
Completely diverging.
When you look at the raw data, total revenue grew by 4.6%. But the actual organic volume, like the physical tonnage of waste moving into their trucks and landfills, that actually fell by 1.6%.
Which is huge. A 1.6% drop in physical volume is not some rounding error.
No, not at all.
That is a material decrease in the amount of material flowing through their infrastructure. So to offset that and still hit nearly 5% top-line growth, the pricing lever they pulled must have been extreme.
Oh, it was. Core price increased by 5.3% on total revenue.
Wow.
Yeah, yielding an average of 3.4%. But the crucial insight here for you as an investor is that this volume drop, it's largely intentional.
Intentional? Wait, they are purposely losing business.
Exactly. Management is actively shedding underperforming residential contracts.
Okay, break that down for me.
They are analyzing their municipal routes, identifying the neighborhoods where the profit margins just fail to justify the heavy asset utilization, and they are choosing to walk away if local governments refuse their price demands.
So they're basically saying, pay our new premium or we aren't coming to pick up the bins.
Pretty much.
It reminds me of a premium software-as-a-service company hiking their subscription fees. You churn some low-tier users, sure, but the remaining sticky customers generate higher total revenue and vastly better margins.
That is a perfect analogy.
Like a city bus route. If a municipal bus drives, say, 10 miles to the edge of the suburbs to pick up just 2 passengers, the transit authority loses money on fuel, wear and tear, driver wages, all for that specific leg of the journey.
Right. The unit economics are terrible.
Exactly. Cutting that stop means losing those 2 fares, but the massive savings in diesel and time vastly outweigh the lost revenue. That is exactly what Republic is doing with these low-tier residential trash routes. They are pruning the dead weight.
And that pruning fundamentally changes their route density.
Mm-hmm.
In waste management, density is the single most important operational metric.
It's all about how many bins you can tip per hour.
Precisely. A residential truck might have to stop every 50 feet. It's constantly braking, idling, accelerating.
Yeah, that destroys brake pads.
It destroys brake pads, burns diesel at an astronomical rate, and requires intense labor. But by shedding those low-density residential contracts, they can reallocate those trucks and drivers to high-density commercial routes.
Like a strip mall.
Exactly. A strip mall where one truck empties 5 massive dumpsters in 20 minutes. The margin profile transforms instantly.
I understand the route optimization on the collection side totally, but I have to push back a bit on the long-term viability of shedding volume when you look at where that trash actually ends up.
You mean the landfills?
Yes, the landfills. Landfills are massive, high fixed cost assets. You have environmental permitting, heavy earth-moving machinery, leachate management systems.
This cost a fortune.
Right, and those systems cost the exact same to operate whether you dump 100 tons of garbage today or 1,000 tons. Don't they need a massive baseline of volume just to cover the operational leverage of a landfill?
They do, and you just hit on it. The landfill operational leverage is the exact vulnerability in this strategy.
Ah, so it is hurting them somewhere.
Yeah. When volume drops at a landfill, the fixed costs are spread over fewer incoming tons, meaning the cost per ton spikes. In this specific quarter, lower landfill volumes created a 50 basis point headwind.
50 basis point headwind. So 0.5% of their potential profit margin was completely wiped out simply because the landfills were operating below optimal capacity.
Exactly.
So they are bleeding efficiency at the landfill level to optimize the collection routes. That sounds like a zero-sum game.
It would be, except CEO John Vander Ark's pricing strategy was aggressive enough to overwhelm that landfill drag completely.
Okay, how?
They successfully pushed that 5.3% price increase onto their sticky commercial and industrial customers. Those customers have incredibly high switching costs.
Right, you can't just pause your commercial dumpster service.
And they often operate in regions where Republic holds a virtual duopoly with maybe one other major hauler. So because of that localized pricing power, the aggressive price hikes completely neutralized the landfill headwind.
Wow, okay.
Yeah, kept consolidated adjusted EBITDA margins rock steady at 32.1%.
Which is phenomenal. But that 32.1% consolidated margin looks bulletproof on a headline basis, but it's an illusion created by averaging.
Oh, absolutely.
Because if you separate the business divisions and look under the hood at the environmental solutions segment, the margins aren't bulletproof at all. They are plummeting.
The contrast is really severe. The core recycling and waste segment, so the traditional trash collection business, that generated $3.97 billion in revenue,
Huge number.
with a phenomenal 33.5% adjusted EBITDA margin. It is a cash printing machine.
Right.
But environmental solutions, which handles specialized waste, only brought in $458 million, which is down 0.9% year over year.
And the margins.
More concerningly, the adjusted EBITDA margin in that segment collapsed to 20.2%.
A drop from their historical averages down to 20.2% is a massive structural bleed. What exactly is the physical reality of the environmental solutions segment that makes it so much more volatile than just, picking up commercial dumpsters?
Well, environmental solutions isn't recurring route-based trash collection. It involves complex, highly regulated operations.
Like what?
Soil remediation, PFAS water treatment, industrial chemical spills, disaster cleanup.
Okay.
The margins are theoretically higher on those jobs, but the revenue is incredibly lumpy. The Q2 report explicitly points out that this segment is suffering from a brutal year-over-year comparison.
Because of what?
Because they lacked a major, non-recurring emergency response project that really boosted last year's numbers.
So last year, they might have been deployed to clean up, a massive train derailment or a hurricane zone.
Exactly.
Which floods the balance sheet with high-margin emergency price revenue. When that specific disaster doesn't repeat this year, the quarterly comparison looks like a severe contraction, even if the baseline business is just functioning normally.
Spot on. That accounts for the revenue stagnation. But the margin collapse to 20.2% is also being driven by equity method investment losses.
Equity method investment losses. Break that down for the listeners.
So Republic doesn't just operate wholly owned assets. They take minority stakes in specialized joint ventures.
Like a cutting-edge polymer recycling facility.
Sure, or a regional biogas plant. Under equity method accounting, because Republic owns a significant stake but doesn't have controlling operational power, they have to absorb their proportional share of that venture's financial losses.
Directly onto their own income statement.
Directly onto the income statement.
So they're essentially taking a financial hit on experimental or struggling partnerships where they don't even have the authority to fire the management or
Correct.
change the operating structure. That raises a structural concern for you evaluating the overall stock. If the core recycling and waste segment eventually hits a pricing ceiling, because there's a mathematical limit to how many times you can hike prices on a commercial client before they seek alternative bids.
Absolutely.
Does this ongoing vulnerability in environmental solutions threaten the raised full-year guidance?
If environmental solutions continues to drag, the core collection business has to work exponentially harder to maintain that 32.1% consolidated average.
Which is a heavy lift.
It is. However, management's current defense against that structural threat isn't really about fixing environmental solutions right now.
What are they doing instead?
It's utilizing the sheer velocity of cash being thrown off by the core pricing strategy to financially engineer their way through the organic volume decline.
Okay, let's break down the mechanics of that cash flow, because you are right. Republic Services is operating less like a traditional logistics company right now and more like a highly sophisticated financial aggregator.
Yeah, the cash generation this quarter was staggering. Q2 free cash flow hit $761 million,
Freeze.
running 21% ahead of the quarter's mark. Year-to-date operating cash flow is at $2.38 billion, with $1.58 billion in adjusted free cash flow.
They are generating cash so fast they are practically forced to deploy it aggressively.
And the immediate deployment is a direct return to shareholders. They executed $651 million in share repurchases in just the first half of the year.
Which artificially boosts that EPS number by shrinking the outstanding float.
Exactly. They also announced a 7.2% increase to the quarterly dividend, bringing it to $0.67 per share.
Wow.
It's their 23rd consecutive annual dividend hike that secures their status among dividend growth investors and creates a hard floor under the stock price.
Right, but buybacks and dividend hikes are standard playbook maneuvers for a mature industrial company generating surplus cash. The true aha moment in this earnings report, the real growth engine that is actively masking that 1.6% decline in organic volume, is their mergers and acquisitions strategy.
Oh, absolutely.
They aren't just returning capital, they're buying inorganic volume to replace what they are purposely shedding.
They deployed roughly $860 million into value-creating acquisitions in just the first half of 2026.
That's massive.
They are currently tracking to blow past their internal $1 billion M&A target for the year. The waste management industry remains surprisingly fragmented at the local and regional levels.
Right, there are thousands of independent, family-owned hauling companies.
Exactly. Companies that lack the capital to upgrade their fleets or implement modern routing software.
And this is where the financial engineering becomes brilliant. Republic buys a local hauler for, say, $50 million. They don't just acquire that company's customer list.
No, they completely got the overhead.
Right. They immediately eliminate the acquired company's back office software. They fire their redundant accounting and HR departments. They sell off the local truck depot.
And integrate those newly acquired trucks directly into Republic's existing, highly optimized routing network.
The margin expansion on that acquired revenue is nearly instantaneous.
By running the acquired company's volume through Republic-scaled infrastructure, they strip out all the operational inefficiencies that plagued the smaller operator.
It's incredible.
This is the mechanism that reconciles the entire earnings report. When organic volume shrinks by 1.6% due to macroeconomic weakness and intentional contract shedding, you simply utilize your massive free cash flow to buy a regional competitor.
You instantly accrete their revenue and EBITDA onto your balance sheet.
And the consolidated top-line growth magically hits 4.6%.
It is a phenomenal strategy for navigating a stagnant macro environment, but you cannot endlessly buy your way out of organic decay. The M&A engine and the aggressive pricing lever are successfully covering up the physical volume drops today, sure.
Yeah.
But we need to look at the macro factors that could eventually break this formula, because there is a very subtle red flag buried in the guidance update that reveals where this strategy is vulnerable.
You're talking about the disconnect between internal management projections and Wall Street's expectations.
Precisely. Management updated their internal adjusted EPS range, raising it to $7.23 to $7.28. It is a confident raise from their previous internal baseline, but that new top-end projection of $7.28 is actually below the Wall Street analyst consensus, which was sitting at $7.29.
It's a tiny miss, but it matters.
Right. If the pricing power is so absolute and the M&A pipeline is exceeding targets, why is their absolute best-case scenario still coming in shy of what the Street modeled?
Well, Wall Street analysts had aggressively baked a macroeconomic recovery into their 2026 models. They were anticipating a big rebound in industrial and commercial activity.
Which didn't happen.
Republic's internal guidance reflects the reality on the ground, that recovery simply has not materialized. The earnings report explicitly highlights continued softness in construction and manufacturing as the primary driver behind the organic volume declines.
That link to construction and manufacturing is vital to understand for anyone evaluating the stock. We aren't talking about residential garbage bins here.
No, we are talking about roll-off dumpsters.
Right. Those massive open-top metal containers you see sitting at construction sites or behind manufacturing plants. The economics of roll-off dumpsters are incredibly sensitive to macro cycles.
Highly sensitive.
When housing starts stall because of interest rates, or when a manufacturing plant slows production, those high-margin temporary dumpsters sit empty in Republic storage yards.
And unlike shedding an unprofitable residential route, losing commercial roll-off volume is purely a macroeconomic defeat. You don't optimize your way out of a stalled construction market.
You just have to wait it out.
Exactly. The other factor, capping their EPS guidance and creating a layer of systemic risk, is their reliance on the commodities market.
Oh, this is a big one. A significant portion of this guidance raise was actually supported by improved recycling commodity prices.
Yeah, they're now modeling commodity prices at $135 per ton for the full year.
Which is a massive jump from their earlier assumption of $115 per ton.
It is. They also explicitly cited higher fuel recovery fees as a tailwind.
But tying guidance to commodities introduces immense volatility. Recycling isn't a closed-loop system. It is a global, export market.
Right.
If they are assuming they can sell baled cardboard and aluminum for $135 a ton, they're relying on strong global demand, often from overseas manufacturing hubs. If global supply chains shift, or if a major buyer pulls back and the market price for recycled cardboard plummets back to, say, $90 a ton, a massive chunk of their projected profit margin simply evaporates.
They have absolutely zero pricing power over global commodities.
None. And the same logic applies to the fuel recovery fees. Waste haulers use complex pass-through formulas in their contracts,
Right. If the price of diesel spikes, they automatically slap a fuel surcharge on the customer's bill.
which artificially inflates the top-line revenue number, making growth look fantastic on a quarterly print. But it is a transient revenue stream.
Completely transient.
If diesel prices plunge, those surcharges disappear, taking the top-line revenue down with them, even if the underlying volume of trash collected remains exactly the same.
Management is leaning really heavily on these transient revenues, high commodity prices, and fuel surcharges to support the 2026 outlook. The core trash collection pricing power is incredibly durable, but the variables supporting the upper end of that guidance are largely out of their control.
They really are.
They have executed flawlessly on capital allocation and route optimization, but the margin for error is shrinking as the industrial economy slows.
Which brings us to the ultimate question of sustainability for you as you track this company. Republic Services has built a fortress balance sheet. They can intentionally bleed unprofitable volume, aggressively hike prices on commercial clients, and still throw off over $1 billion in adjusted free cash flow to gobble up regional competitors and buy back their own stock.
It's an incredible machine.
But the underlying physical metrics tell a clear story of a slowing macroeconomy, and their forward guidance requires global commodity prices to remain elevated.
It is a masterclass in financial and operational management, masking a difficult physical reality. The strategy works perfectly right up until the moment the macro headwinds outpace the M&A accretion.
As we wrap up this analysis, I want to leave you with a systemic risk to evaluate, one that ties directly into how Republic Services is achieving these massive pricing gains.
The AI pricing.
Yes. The sources highlight Republic's ongoing integration of an AI-driven pricing transformation. They are deploying advanced algorithms to optimize pricing down to the hyper-local individual customer level, and they expect the system to yield $100 million in annual benefits by 2028.
That's a huge benefit.
It is. But consider the reality of their customer base. As waste haulers increasingly rely on AI to calculate the maximum extractable yield from every single contract, what happens when these relentless algorithmic price hikes collide with cash-strapped municipal budgets?
It's a collision course.
Will tech-driven margin expansion eventually hit a brick wall of local politics, where city councils simply refuse to pay the algorithmic premium, forcing Republic to either abandon massive regional footprints or break their own pricing model?
It is the ultimate test of their operational philosophy. Because an algorithm can perfectly calculate the optimal price point, but a local mayor facing re-election ultimately holds the pen to sign the contract.
Follow the show for your daily earnings coverage.